Hey everyone, it's Ben Hardy here, and in today's video, we're going to be going over the current banking situation because, well, I have some updates for how this is actually affecting the car market in real time. Before we get into this video, though, as always, if you want to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. So this whole Silicon Valley Bank situation has definitely blown up to a massive proportion. I mean, again, it was initially just an issue with one bank, and now it turns out that there are several banks that are having issues similar to Silicon Valley, and you have people now questioning the entire banking system. And obviously people were questioning the banking system prior to this whole situation, but again, it's now like the topic. Like, this is what everyone is talking about right now, and it's having some real world effect on businesses. The first effect is to smaller regional banks. A lot of smaller regional banks have had a lot of their customers pull money out, and if they happen to be publicly traded companies, a lot of these smaller regional banks happen to have people selling off their stocks like crazy. Now, that is what was initially happening at the beginning of me doing the research for this video. But in between then and now, as of me filming the video, what has changed is some of these regional banks have seen a massive amount of cash starting to flow back in terms of, customers going back and depositing money into the banks. And then they've also seen, some of them have seen their stock prices go back up because people started buying the stocks. And so it was kind of what you could almost call like a quote unquote flash crash, right? Where everyone pulled out all at once. And then everyone's like, oh, wait. So the federal government's going to do some stuff, and we'll talk about that stuff in just a moment. And so then they kind of like jump back in. They're like, okay, I'll put my money back with you, and I'll buy the stock back. It's okay. We'll just go back to normal. And what the FDIC has been saying is that they are going to insure more than $250,000 to the clients of Silicon Valley Bank. Now, there's still a little bit of a gray area as to whether or not this is going to extend to other lending institutions if they have a fallout similar to Silicon Valley Bank. Again, we just don't know at this point, but that's a huge change because, again, the status quo before was $250,000 if a bank fails, and now they're like, yep, we'll just make sure that every single client with Silicon Valley Bank gets their money. And again, I am not an expert in this field whatsoever, but from the research that I've done, what it sounds like is happening is basically the FDIC collects insurance fees from lending institutions as part of basically an insurance thing to provide that $250,000 if a bank goes under, and they're going to use this pool of money that they have to basically bail out all of the people that, lost money in the Silicon Valley Bank failure. And obviously, their assets and everything that they can sell off, but those assets of Silicon Valley banks that they will be able to sell off and get money for, that'll take some time. So it sounds, again, not an expert, so let me know in the comment section down below if I'm getting this section wrong. It sounds like they're basically going to take the cash reserves the FDIC currently has, use those cash reserves to make sure these clients get their money, and then they're going to sell off the assets and then use the money that they make from those assets to then build back up the cash reserves, so then they can use those cash reserves in the future as insurance if another situation like this happens. And so because of all of this, because of the failure of Silicon Valley Bank, because of the bank run that we basically had, especially on regional institutions, because of the massive drop in stock prices and just the overall lack of trust within the banking system, there has been a lot of talks of the fact that the Federal Reserve might not go through with their rate increase at the end of this month. And that would obviously have a lot of implications when it comes to the overall car market. And so now let's dive into what we are currently seeing. So first off, when it comes to rate increases, this obviously is going to be directly correlated with affordability with cars. If the Federal Reserve continues to increase rates like they have been, well, then that means that cars are going to become less and less affordable, which means more and more people are going to be pushed out of the car market, especially the new car market, because the average new car buyer finances their purchase, which means that if automakers want to continue to sell cars, new cars rather, then what they're going to have to do is, release bigger incentives to basically counteract these higher interest rates. And so there's the implication there if we just keep going down the road that we're going. However, if the Federal Reserve pulls back and says, we're actually not going to increase rates, and maybe they even pull back even further and go, will actually decrease rates, then this is going to completely flip the market dynamics, and it's basically going to put automakers in a position where they feel extremely justified. They're going to be like, yep, this is why we increased prices. This is why we haven't released any sort of discounts, because interest rates are now coming back down, which means affordability is going to go up, which means that more people are going to be able to come back into the car market, which means that we have all the pricing power in the world. And so although some people might see it as a good situation in terms of interest rates, stopping with the increases and potentially going back and decreasing because of the situation, it's not going to be good for the car market. It's just going to give automakers even more pricing power. And frankly, it's probably going to lead to even higher car prices, which it's not really good for anyone, well, other than automakers, of course. And then when it comes to lending institutions, this whole situation has had an immediate effect, especially to the smaller regional lenders. Basically, they have had to pull back in terms of their ability to give out auto loans. And this is something that I have heard in real time from several dealers. Again, in the last video, I commented on how this was something that might happen because of the situation, and I said it's too soon to tell. Well, now I have confirmation from dealers that they basically went to a lending institution that they normally go to, and the lending institution denied giving their customer a loan. And this is a customer that just a few days ago would have gotten the auto loan. And again, it makes sense. If you have people pulling out money, then these lending institutions have less cash on hand. And if they happen to be a publicly traded company and their stock price falls a mass amount, well, that means that they have less access to capital in general, so they're going to be less willing to give out loans unless those loans make sense where they can get a guarantee off of their money. And so what it basically looks like is happening is anyone that is below perfect credit is just not really a consideration for these lending institutions that are currently struggling until the situation kind of figures itself out. And so it's pushing the market more in the direction of the haves and the have-nots. Again, with this whole market, it's been a market where you basically have to have money to be able to purchase a car. Anyone who makes a normal amount of money just isn't going to be able to be in the car market. But now it's you have to have money and you have to have perfect credit, or else you're not going to be able to purchase a car. However, this whole situation is not exactly an equal situation in terms of how it's affecting lending institutions, because the larger lending institutions, think the ones that are national, that are really big, they actually have had a lot of cash basically flow into their coffers, because what people have done is they've taken money out of regional banks and they've put them in the larger banks, because they feel like the larger banks, right, they're too big to fail, even though Silicon Valley Bank was, I think it was the 16th largest in the nation. But regardless, they think they're too big to fail, and so then these banks now have a bunch more money compared to what they had before, and so they're actually more willing to give out loans like auto loans, for example. And so this is shifting dealers to work with these larger lending institutions that don't necessarily have the best interest rates. Now, obviously, they want to be competitive within the lending world to get customers, but what you will typically see, at least in the car business, is the smaller regional lenders will be a little bit more aggressive compared to the larger lending institutions, because they have a better feel for the market that they're within, right? They kind of will try to basically get a captive market within a certain region. They understand the demographics within that region, all that kind of stuff, and so they're willing to typically give better deals to people that are local to that region. Whereas again, the big lending institutions, they're just national, and so they're big enough that they're yeah, we don't need every single customer. We'll just get as many as we can. And so that's another effect, is it's basically putting dealerships in a position where they're having to bump people up with their car payments, because they're basically getting higher interest rates, which is leading to their customers having higher car payments, obviously. Okay, well, that last section was jumbled, but I really don't feel like doing it over again. So that is going to sum things up for today's video. Let me know what you think about this whole situation, where you think that this situation is going to lead us to in terms of, I guess, stuff outside of the car market, if you're interested in talking about that, and then also within the car market as well. If I put on my tinfoil hat, which I sadly don't have anymore, my guess as to what is going to happen is, I think that, yeah, we're probably going to see quite a bit of money flow out from the FDIC to try to stabilize the situation as much as possible. But I do think that we're going to see some more bank failures. Now, I don't know how large the failures are going to be, but I do think that this is basically going to kind of be like a chain reaction type situation where more banks will go under, and then it'll cause more fear, which will cause just volatility in the short term. But I'm kind of an optimist in situations like this where I think it's going to get figured out, and then we're pretty much just going to go back to the status quo where interest rates are most likely going to continue to increase, which means that, well, affordability with cars is going to continue to decrease. So again, let me know your thoughts. See ya.